David, welcome back to the show. What do you think about that video from CNBC?
Well, I'm pretty much in agreement. I mean, what she's saying is true. I mean, the biotech sector and also the social media sector are way overbought. I mean, there's no question, and have high PEs. But stay in the Federal Reserve business and the monetary business for sure. But it's one of her only weapons left. I mean, you're talking about tapering ending in October. So she's really jawboning down the market. Everybody thinks that the market's overvalued and overheated and due for a correction. So it's kind of one of her ways to help to keep people in check a little bit.
We'll clarify that, David. So we know we've had this QE3 deal. It's going to be tapered down to nothing in October. You have short-term interest rates at 0.25%. Prior to that, you've had every four-letter acronym thrown at the economy, from TARP to HARP to HAFA to tax credits. I mean, a lot of things have been thrown to try and stimulate this economy. So it does seem like we're running out of bullets here. So what do you think her purpose was with those comments?
Well, like I said, I call it jawboning, saber rattling. There's all kind of terms that people use in the marketplace. She just wants to create a little bit of caution in the market. I mean, asset prices, both on real estate and stocks, are we've already seen asset bubbles back in the Greenspan era and the old irrational exuberance. So this is not something to be taken lightly. Right now, there's a couple concerns I have. We have another subprime crisis that I think is potential. Not as big as the housing, but the automobile sector right now, believe it or not, we have the highest number of subprime loans for auto purchasers since 2006.
Wow, no kidding.
That's a cautionary flag. Good news, they're lending. The banks are lending. Bad news is they're starting to lend to not as qualified buyers due to a little greed in the spreads they're making. A couple of terms I always use: divergence. We have some pretty serious divergences happening. One that's real kind of right in your face is the S&P 500 is up 8% year to date, while the Russell 2000, the small company stock index, is actually down 1%. Usually in really sustainable bull markets, you're going to have the S&P, Dow, Russell all kind of rise together. The last one I'll talk about is the high yield bonds. High yield bonds typically track the stock market, the S&P, and recently they're down about 1.7%. And the market was up 1%. Again, that's a divergence. And last time that happened, we had an 18% correction in 2011. And as you know, I've talked many times, we're overdue. It's been 33 months since a 10% drawdown. We're also entering election season for midterms, which has an average 17% drawdown. So, things are starting to line up, for some type of pullback.
I saw on the top of Yahoo Finance page this week, which isn't necessarily the best source for information, but the writer, the author of this piece, was saying that he expects there to be a 20% correction, and it's already happening right now. Now, whether that's true or not, nobody has a crystal ball, but the one thing I'd encourage you to do, visit David online. He gives a free review just to make sure that everything's okay on everything that you are doing. If there's going to be a correction, you'd like to know if there's any holes in your game, whether it's your financial plan, your retirement plan, anything along those lines. David is a great guy to connect with. Here's his website right here. Go visit him online and learn more about how you're exposed and what opportunities are there for you. David, appreciate the Reyes Report today.